We all have this picture in our heads. It's a picture we've been fed since we were kids. You earn money, you take that money to a bank, and the bank keeps it safe, like a warehouse for your cash. You imagine your money sitting in a vault, maybe in a little box with your name on it, just waiting for you to come back and get it. It's a comforting idea, but it is a complete lie. If banks were just warehouses, they would charge you storage fees. You'd pay them to hold your cash, but they don't. In fact, often they pay you. They give you interest. Have you ever stopped to ask why? Why would a business pay you to store your property? Because once you hand that money over the counter, it's not your property anymore. It's theirs. And they are going to use it to run one of the most profitable, complex, and misunderstood money machines in human history. Today, we are tearing down the facade. We're going to look at the machinery of banking in 2025. We'll uncover the secret of the zero reserve reality that started in 2020, something almost nobody talks about. We'll expose the invisible tax you pay every time you tap your card. And we'll explain how banks have turned debt into a video game that you are rigged to lose. Buckle up, because you are about to see where your money actually goes. To understand the modern bank, we have to go back to the original hustle, the goldsmiths. 500 years ago, people deposited gold for safekeeping. The smiths gave them paper receipts, but the smiths noticed something crucial. People rarely came back for their gold all at once, so they started writing receipts for gold they didn't have. They lent these receipts out and collected interest. As long as everyone didn't ask for the gold back at the same time, the goldsmith was rich. This was the birth of fractional reserve banking. Fast forward to today. The principle is the same, but the scale is terrifying. When you go to a bank to get a loan, say $500,000 for a house, where does that money come from? You might think they take money from a saver, Mrs. Jones, and hand it to you. That is the intermediation model, but that's only half the story. When the bank approves your loan, they don't move money, they type it. They simply update your account balance from $0 to $500,000. In that millisecond, $500,000 of new money is created. It didn't exist before. It wasn't in a vault. It was birthed into existence by the stroke of a keyboard. This is the big secret. Banks create money. In fact, economists estimate that over 90% of the money in circulation wasn't printed by the government. It was created by private banks issuing loans. Historically, there was a leash on this. It was called the reserve requirement. For a long time, banks had to keep about 10% of their deposits in reserve. If you deposited $1,000, they could create $900 in new loans. That money would get deposited at another bank, which would keep $90 and lend $810, on and on. A $1,000 deposit could theoretically become $10,000 in the economy. But here is the twist that most textbooks haven't caught up with yet. In March 2020, right when the world was locking down for the pandemic, the Federal Reserve did something unprecedented. They slashed the reserve requirement to 0%. As of late 2025, that requirement is still effectively zero for the vast majority of accounts. The old textbook model of reserve-constrained lending, it's dead. Today, banks aren't limited by how much gold is in the vault. They are limited only by their capital, their financial cushion against losses, and by whether they think you can pay them back. They are creating liquidity out of confidence, and that confidence is what they sell. Okay, so they create money. But how do they profit? It's actually just like this grocery store. They buy low and they sell high. But they don't sell milk, they sell debt. This is the engine room, net interest income. It works on a concept called maturity transformation. Think about your savings account. You can walk in and take your money out whenever you want. That's short-term money. Because it's so liquid, the bank pays you a tiny interest rate. Let's say 0.5%, or maybe 4% if you're lucky in a high-rate year. But then, they take that capital and lend it to a homeowner for 30 years. That's long-term money because the bank is locking that money away for 3 decades. They charge a much higher rate, say 7%. That gap, that 3% difference, that is the spread, or the net interest margin. It sounds small, but when you apply it to trillions of dollars, it builds skyscrapers. This is why banks are obsessed with the Federal Reserve. When the Fed raises rates, banks can charge more for loans immediately. But, and here's the trick, they are very slow to raise the rates they pay you on your savings. It's called deposit beta, When rates go up, their profit margins explode. But living off the spread is dangerous. If everyone defaults on their loans, the bank collapses. If interest rates drop too low, the margin disappears. So, in the last decade, banks realized they needed a better way to make money, a way that didn't involve risk. They decided to stop just being lenders and start being toll collectors. Cash is a problem for banks. If I hand you a $20 bill, the transaction is finished. The bank learns nothing about me. The bank makes $0 from that exchange. Cash is the enemy of profit. Every time you tap this card, an invisible tax is levied. It's called the interchange fee. Let's look at the four-party model. It sounds boring, but it's an automated money fountain. You buy a coffee for $5. The merchant doesn't get $5. They get maybe $4.85. Where did the 15 cents go? A few pennies go to Visa or MasterCard. A few pennies go to the merchant's bank. But the lion's share, the vast majority, goes to your bank. In 2024, US merchants paid a record $148.5 billion in these processing fees. Think about that. $148 billion siphoned off the top of the economy. This is why you can't use cash at the cool new salad spot. This is why cashless is a trend. It's not just about convenience, it's about data and fees. Banks love premium cards. Why? Because they charge higher interchange fees. A basic debit card might cost the merchant 0.05%. A Visa Infinite or World Elite MasterCard, that might cost the merchant 2.5% or even 3%. When you pull out that heavy metal card to pay for dinner, the restaurant owner cringes. They are paying a premium so you can get your airline miles. It is a wealth transfer from the merchant to the bank, with a little kickback given to you in the form of points. And that brings us to the darkest part of the machine, the psychology of why you use the card in the first place. Banks have hired behavioral psychologists to design their products. They figured out a glitch in the human brain called payment decoupling. When you pay with cash, you feel it. It's called the pain of paying. Your brain registers a loss. It hurts. It acts as a natural brake on spending. But with a credit card, that pain is numbed. You get the product now. You pay later. The consumption is decoupled from the payment. Research proves it. People spend 12% to 18% more when they use plastic compared to cash. You buy the extra appetizer. You upgrade the seat. Because it doesn't feel like real money yet. And the rewards, the points, they are the hook. It's gamification. You chase the points. You tell yourself, I'm beating the bank. I'm getting a free flight to Hawaii. But are you? If you carry a balance, even for 1 month, at 24% APR, you have erased the value of those points instantly. And even if you pay it off perfectly, the bank still wins because you spent 18% more than you would have with cash. The interchange fees on that extra spending alone make them rich. The free flight wasn't free. It was funded by the merchants you shopped at, who raised their prices to cover the fees, and by the millions of people who didn't pay off their balance on time. If interchange is the invisible tax, overdraft fees are the penalty for being poor. This is non-interest income in its ugliest form. For years, banks charged $35 every time you bought a $4 coffee when your account was empty. In 2024, despite huge regulatory pressure to stop this, consumers still paid over $12 billion in overdraft and non-sufficient funds fees. Here's the nuance. The giants, JP Morgan Chase, Citi, Bank of America, they can afford to cut these fees. Chase still made over $1 billion from them in 2024, but that's barely 2% of their profit. They are pivoting away because it looks bad. But the smaller banks, the credit unions, they are addicted to these fees. For some, it's the only thing keeping the lights on. This creates a weird dynamic. The evil big banks are actually becoming safer for low-income customers because they are eliminating the fees, while the friendly community banks are struggling to survive without charging you $35 for a mistake. There is one more way banks make money that nobody sees. It's called shadow banking support. You know all those cool fintech apps? The ones that promise to give you a mortgage in 10 minutes on your phone. They usually don't have any actual money. They don't have deposits. So where do they get the cash to lend you? They borrow it from the big banks. This is called a warehouse line of credit. Think of it like renting money. The big bank acts as a wholesaler. They rent $1 billion to the fintech company. The fintech company lends it to you for your house. Once the fintech company sells your mortgage to investors, they pay back the big bank. The big bank takes zero risk on you. They don't care about your credit score. They just rent the money to the fintech and collect a safe, easy fee. They have outsourced the risk while keeping the profit. So let's recap. They create money out of thin air when they lend. They profit from the spread between what they pay you and what they charge you. They tax every single digital transaction through interchange fees. They gamify your psychology to make you spend more. And they rent their balance sheets to the apps on your phone. The modern bank isn't a warehouse. It's a data company. It's a software platform. In 2025, cash is dying. And as it dies, the bank's control over the economy tightens. Every tap, every swipe, every loan is a data point they monetize. The next time you see a 0% interest offer or a free rewards card, remember, if you aren't paying for the product, you are the product. The house always wins. And in this casino, the bank is the house. If this video helped you understand where your money really goes, hit subscribe, not for the algorithm, for yourself, because the next videos go deeper into why the rules keep changing and who they really benefit. Leave a comment if something here surprised you, or if you want us to break down a part of the system you don't trust. And share this with someone who still thinks the bank is just holding their money.